Hey, Thomas Castelli here, and in this video, I'm going to break down the strategies that you can use to maximize the tax benefits of owning short-term rental properties. So, underneath the tax code, there's a section called Section 469, the passive loss rules, which make all rental properties passive by default. And what that means is you cannot use the losses from your rental properties to offset your income from your W-2 job or active trader business. And that can be quite a problem because if you're able to do that, you can use those losses to significantly reduce the amount of taxes that you're paying. However, there's an exception underneath the regulations that basically makes short-term rentals go around that rule and allow you to use the losses from your short-term rentals to offset your W-2 or active business income and save significant amount of money in taxes. This has become known as the short-term rental loophole. So I'm going to break that down for you in just 1 second and why you'd even want to have losses on a rental property in the first place. But if you do like this video, make sure to hit that like button to help get this video into the hands of more investors and help them become tax smart. Also, be sure to hit that subscribe button and the bell icon so you don't miss out on future tax smart videos. Okay, so what is the short-term rental loophole and how can you use it to save significant amounts of money in taxes by investing in short-term rentals? All right, so it works like this. So again, all rental activities are passive by default, which means that you can't use the losses to offset your income. But if you have an average stay on your short-term rental activity of 7 days or less, then it is no longer a quote-unquote rental activity underneath the tax code. Instead, it's just a regular business activity. And if you materially participate in that activity by meeting one of 7 tests, and there's usually 3 tests that are going to be relevant for most taxpayers, and that is that you spend more than 500 hours on the activity, or you do substantially everything. So effectively, you're a one-person show, or you spend more than 100 hours on activity and no one other individual spends more time than you, then you will meet that requirement. So you just meet one of those, average stay of 7 days or less, and now you can use the losses from your short-term rentals to offset the income and then thus the taxes that you're paying on your W-2 or active business income, which can be quite significant. Now, why would you want to have losses on your rental properties to begin with? Well, the good news is with rental properties, this is one expense called depreciation, which is non-cash. And what does that mean? It means that it's an expense that is only on paper. So if you take a look at your profit and loss statement, you're going to have income, then you're going to have expenses like advertising and marketing and utilities and taxes and legal and professional fees, repairs and maintenance, all that good stuff. That's money that actually leaves your pocket or your bank account and goes to a third party. So for example, if you had $10,000 in short-term rental income, right? And then you had $5,000 in hard expenses, so expenses that leave your pocket, then you will have $5,000 in income. And normally you'd pay tax on that income. However, with depreciation, that non-cash expense can actually reduce your income to below zero. So for example, just say you had that $10,000 in rental income, you had the $5,000 in hard expenses, but now you have this $6,000 non-cash depreciation expense. Well, you'd have a net loss for tax purposes, which means you're not going to pay tax on your rental income, which is a major win. Clap it up because you just put $5,000 of cash flow into your pocket, but you have this $1,000 loss, which causes you not to pay any taxes on it. So clap it up. You just captured the first major tax benefit of investing in short-term rentals. And by the way, this applies to most other rental properties as well. But what I'm about to break down right now is going to be really powerful for short-term rental investors. Again, if you met that requirement of 7 days or less and you materially participated, well, now that $1,000 loss that I just mentioned can help offset your W-2 income. So for example, let's say you had $100,000 in W-2 income. Well, now you're only going to be paying taxes on $99,000, all right? But it gets even more powerful than that. So there's something called bonus depreciation, which as of this recording in 2023 is at 80%. And what that does is allow you to significantly increase your depreciation expense in the first year of ownership. So kind of just give you a quick example of what that would look like. I'm going to pull out my calculator. I'm going to do this live here on this video with you. Let's say you bought a $500,000 property, right? And 80% was the building, right? So you can never depreciate land. And we have plenty of videos on the Tax Smart Investors channel here that go through that in greater detail, but you can't depreciate land. You can generally only depreciate the building and the improvements on the property, the land improvements, things like the pool, the shed, etc. So again, $500,000 property, and we're going to assume that 80% is the improvements. So that's the building and any other land improvements that might be on your property. That means your property is going to have $400,000 of depreciable basis. Now, let's just say out of that, 20% can be allocated to bonus depreciation. It could be a little bit more than that. In many cases, it's 25%. But to be conservative here, let's just say it's 20%. All right. So we're going to go ahead and take that $400,000. We're going to multiply it by 20%. We're going to get $80,000. Okay. Now, 80%, up to 80% of that is eligible for bonus depreciation. So we're going to go ahead and multiply that by 80%. I'm going to get $64,000. So this is a non-cash expense that you're going to get. So let's go back to our example real quick, right? You had $10,000 in rental income. Now you have $5,000 of hard expenses. That's money that left your pocket, okay? But now you're going to have $64,000 in depreciation. So we're going to go, you're going to have, now with that $64,000, you're going to have a net loss of $59,000. And let's just say you were earning that $100,000 in W-2 income again, right? So you're going to now take that $100,000 and you're going to offset it with that $59,000. And now you're only going to pay tax on $41,000. So let's just say that you were in the 22% tax bracket. How much is that $59,000 worth to you? That $59,000 loss is basically going to be worth $12,980. But let's step it up a level. What if you're in the 37% tax bracket? That's the highest tax bracket under current law, right? So we're going to go ahead and take this $59,000 loss and we're going to multiply it by 37%. And we're going to find is that's actually worth $21,830 in tax savings. That's significant. That's quite powerful. You just saved 5 figures in taxes by using the strategy. And the reality of the situation is it's actually even more than that, because remember, the depreciation expense help you offset $5,000 of rental income as well. And rental income is also taxed at your ordinary income rate. So really, the reality is this $64,000 expense really helped you save, if you were at the 37% tax bracket, $23,680. So that's just kind of showing you the power of this strategy. So let's summarize this. So if you have a short-term rental property and it has an average stay of 7 days or less, it's not going to be considered a rental activity, which means the losses are not passive by default. And if you materially participate by meeting one of the 7 tests, the 3 we discussed in this video, you spend 500 hours or more on the activity, you spend more, or you spend more than 100 hours on activity and no one else spends more than you, or you do everything yourself, then guess what? You're going to be able to use the losses from your short-term rental to offset the income from your W-2 job or an active trader business that you're running, or any other non-passive income if we really want to get technical here. So it is really powerful. And then to answer the question, why would you even want to do that in the first place? Why do you even want losses? Well, it's because of the non-cash expense called depreciation that allows you to do that, right? And it's because it's the loss is only on paper. It's not money that's coming out of your pocket. So do you have questions on this? Go ahead, drop them in the comments. We're going to answer as many of those questions as we can. And remember, if you did like this video, be sure to hit that like button as well as the subscribe button and the bell icon so you don't miss out on future videos. And last but not least, if you do want to join in on the conversation and you have questions about how this can help you reduce your taxes, then you can also join our free Facebook group where dozens of conversations are already taking place right now as we speak. You can head on over to www.facebook.com/group/taxsmartinvestors or click the link in the show notes to join the group today. Thanks for watching. We'll catch you on the next Tax Smart video.